For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about how to master the retirement income trifecta, cash flow, longevity, risk, and tax efficiency. Also, how 401k savers just triggered a big market shift, mutual funds, or an ETF, which is better for your IRA. And then finally, what happens if you die without a will in Missouri. My name's Jeff Shade. I am just here to ask the questions for you. But of course, the words of wisdom and solid advice, they come from Jake Floyd at Floyd Financial Group. Hey, Jake, good morning. How you doing today?
I'm doing great, Jeff. Thanks for asking.
Certainly welcome, my friend. I hope everybody else having a great weekend. As always, we really appreciate you joining us right here for Show Me the Money. Jake, a lot of people think retirement planning is all about building a big nest egg, but today we're going to be talking about something I think a little bit different. What happens after retirement? What is the retirement income trifecta?
Yeah, so when you get to retirement, this is something that I spend quite a bit of time talking about in client meetings, is before you retire, you are focused on your gross income. You want to maximize how much income you have coming in, and you find all different sorts of ways to do that, whether it's your job or side hustle or rental properties or whatever it is. When we get to retirement, there's basically three main things we want to pay attention to. So the first one is cash flow, then longevity risk, and tax efficiency. Those are the things, and I'd say cash flow is definitely, at least in our area here, probably the biggest of those three. There are other places in the country have more tax issues than we have here. Not that that doesn't matter here, it definitely matters, but how many dollars you got going in versus how many you got going out is the name of the game, cash flow.
Okay, so cash flow, longevity, risk, and tax efficiency. Would you say that cash flow is pretty much 2/3 of the equation, or are they equally weighted?
No, I would say cash flow is definitely the main part of this. And the reason for that is when you're working, you're going to be most likely in a higher tax bracket, especially if you have a couple and you both have a job, you're likely going to be beyond the 12% tax bracket. When you go to retire, you don't have to fund your 401k anymore. You don't pay Social Security tax. You don't have Medicare, Medicaid, and FICA, and all the things that you have to pay out of your payroll tax. And so your net number, I find for most people, is somewhere between 45 and 55% of your gross pay. So we don't really need to replace all that gross pay. We really just need to focus on cash flow. And when I say that is instead of maximizing how much income we have, we can also focus on how to reduce outgo. And in some ways, that's even better because it doesn't come with a higher tax bill.
Yeah, and I think many people confuse income and cash flow. They're actually two different things. Well, I've got this much income. It's a huge amount of income here, but hey, on the other side too, the outgo, the cash flow is huge as well too. So I think really the goal here is to separate those two by as much as you possibly can. What is the first step in building a retirement paycheck? And I'm going to talk about a reliable paycheck, some of the basic things that you need to keep the lights on, the roof over your head.
Yeah, so we need to first understand, like any goal, where we want to go if we're going to find a road to get there, right? So we need to understand how many dollars we need to be spending in retirement to make retirement look the way you want it to look. Some people are forced to live a retirement that they can live, not the one they want to live because they didn't plan in advance. But we need to look at your spending and see realistically what it's going to take to replace what you're spending now. A lot of times the way I like to start that process is if we look at your net paycheck while you're working, a paycheck that actually hits your account. So again, that's not for everybody, but for a lot of people, that's 45 to 55% of the income after insurance comes out, taxes, 401k, all the other stuff. And then we take that net paycheck and then we add back in the cost of healthcare and add back in taxes. And that's a pretty good starting point because most people today do not have a traditional budget. I do occasionally get surprised. Probably 1 out of 100 people or so will bring a budget in. Most people are like, I have no idea what I spend And that's okay. You're just making more than you're used to spending, and so it hasn't really been an issue for you. But when we get to retirement, we want to make sure we have a plan that accounts for whatever it is that we're spending, the things that you want to do. And so we need to have that first step of knowing what's our target, and then we can work on how to get there.
So, Jake, as far as creating a reliable paycheck, a paycheck that pays for your basic needs, what I will call your dignity floor, where do we start with that? What are some of the sources?
Yeah, so Social Security is kind of the obvious one out there, but it's also one of the least trusted ones at this point because everybody knows that Social Security is going to run out of money here in a few years. The fund of Social Security will run out, and so people are concerned about that. I would say that for people listening to this show, I would not lose a lot of sleep over whether or not Social Security is going to be there for you. I do think it's going to be there for you. And this is a topic for another time, but I also don't think it's going to get cut. I think if anything, it will get expanded, and we can go down that road, like I said, at another topic, but I would not be concerned about Social Security going away on you. If you have a pension, that would be another part of this where we could say, hey, here's our Social Security income, here's our pension income. So if you're a teacher or if you're a union worker of some sort, you might still have a pension. I think it's something like less than 12% of all workers still have a pension, but if you have one, count yourself lucky. Then there can be other pieces to that puzzle: CDs, bonds, rental income, annuities. There's a lot of other ways to generate that income, or simply just taking what we call free withdrawals, or just taking money out of your investments systematically, but responsibly. And once we have looked at all those pieces, then we can kind of add that up and see where we're at relative to your target. If we've met that target, then hooray, right? We're good. If we have not met that target, then we need to figure out how to save money, how to invest money to get you where you want to be.
Jake, most people do have Social Security. I would say, over 90% of people have that. As you said, not a lot of people have pension income these days. So people are relying on things such as certain annuities to create some cash flow. And many people say, well, I don't like annuities. And when I talk about certain annuities, what sort of annuities are we talking about here that would provide a reliable paycheck?
Sure. I mean, really, most annuities are, in fact, if you take the state of Missouri's insurance exam, it will tell you that the annuities are for the liquidation of an estate. That's the basic definition of annuity, which is crazy because they do so much more than that.
Sure.
But the primary function of annuity is to make payments. And so whether those are income payments or just payments over a certain period, you can turn on lifetime income out of annuities, although I'm generally not a fan of the lifetime income riders because they're expensive. Annuities also can provide a blanket of safety to also help you not run out of money in retirement, because if you've done a good job saving, your biggest risk is like a 2008 scenario, right? And we need to figure out a way to put things in place to take that catastrophic scene off the table. But yeah, annuities, there's a lot of ways to take income from annuities. Some annuities have liquidity features. Some annuities are not very liquid. So it's important to know what types of annuities there are out there. And again, I don't know that we want to turn this whole segment into an annuity thing, but fixed indexed annuities are in a pretty good place right now with interest rates as high as they are. That's the horsepower behind a fixed indexed annuity. So we just want to use whatever the best tools are to get you to where you want to go. And those change over time. So if you have a financial advisor who just does the same thing every single time he sits with somebody, chances are at some point he's going to get caught flat-footed. We want to be able to adapt to the situation and use what makes the very most sense for each client individually as time moves forward.
We're talking with Jake Floyd of Floyd Financial Group, and we're talking about how to master the retirement income trifecta: cash flow, longevity, risk, and tax efficiency. Once again, if you'd like to have a conversation with Jake on a one-on-one basis, you can call us right now at 417-889-7233 and set up that conversation. It's the Floyd Financial Group Retirement Review. Absolutely no cost, no obligation, and certainly no judgment. It's 417-889-7233. Jake, one expense that catches people off guard is healthcare. How should retirees prepare for healthcare?
Yeah, so understanding what your plan is going to pay for. So first of all, if you're under 65, understanding how Obamacare or some of these other plans work, understanding what they pay for, what they don't pay for. If you're over 65, understanding what Medicare is going to pay for and what you're going to need, like a Medigap plan or a supplement or whatever, to fill in the gap. And even then, what you're still potentially on the hook for. So understanding where bills are going to come from. Once you're 65, for the most part, unless we're talking about long-term care, Medicare is going to be a step up for most people's health insurance. It's going to cover quite a bit more than what they're used to it covering in today's world. Certainly if you're on Obamacare and you move from there to Medicare, it's going to be way, way better. So just as far as total out-of-pocket, monthly premiums, but also your out-of-pocket maxes are much lower. But understanding, how much you're paying, your premiums, deductibles, prescriptions. Long-term care is the big one, and that's a hard one to account for because some people need zero and some people need millions of dollars worth. And it's just hard to account for that. But those are things that we need to have an eye towards.
Jake, let's move on to the second part of the trifecta here, which is longevity risk. What does that actually mean, and why is it important to plan for?
So longevity risk is basically the risk that you may outlive your money. Some people come in and they have $500,000 and they start pulling $50,000 a year out. If you do that, you will eventually run out of money unless you are an investment wizard, which is possible. But for the most part, that's way too much money to be withdrawing off of $500,000. And if you retire at 65 and you live to 70, then you're not going to run out, right? But if you live to 90, your chances of running out have gone up several times over. So understanding how long you're likely to live, or at least maybe an upper limit of how long you might live. I like to plan for 95, all things equal. There are some people that we plan longer for if they have a lot of longevity, like you, Jeff, and your family with your aunt at 107, or is she 108?
She's 108 years old now.
108. That's crazy.
Amazing.
I would be planning for you to live till you're 150, Jeff. But I think that for the average person, 95 will probably cover it. That's going to cover 98% of people. But there's a lot of people that don't think they're going to live past 75. And in today's medical world, they can do ablations in 15 minutes and fix heart attacks through your wrist. And and before long, I think there's going to be very few organs that they will not be able to 3D print and put in your body that will work for you. And so we need to plan like we're going to be here longer than you might think initially.
Right. And medical technology is just amazing these days. And I think living to 100 will not be that unusual here in the very short future. Let's talk about annuities again here in the role that it plays as far as longevity risk. If you do have an annuity, does it necessarily pay you for life?
Not necessarily. So an annuity can pay for a fixed period called a period certain, or it can pay for life, or it can pay for a joint life, meaning like you and your spouse. Or it can pay 10 years certain and then for life, meaning you get at least 10 years of payments. There's a lot of different ways it can pay out. And the pricing, meaning how much you get for how much money, changes as you manipulate that structure. But those are all things that we can talk about, and whether annuity is even right for you, right? I think there's a lot of people that annuities are not right for. And it seems like everybody on the radio and everywhere else is just trying to cram annuities down everybody's throat. And so I do use annuities where it makes sense, but every single person that walks in my office, the annuity is not the miracle pill. And so there's some people that don't need it. There's some people that really like them, some people that don't like them. But what we want to do, like I said before, is just use the best tool for the job.
Jake, let's talk about the third leg of the stool here, which is going to be tax efficiency. Why is this so important for retirees or pre-retirees to think about?
Any money we don't pay in taxes is money that stays in your pocket, right? And that's just that much less money you have to come up with in order to get to the goal that you want to get to. So where we can, we want to be tax efficient. But I will say that in today's world, I have a lot of people that retire from a 30 or 40-year career, and their main, if not their only asset, is their 401k. And in that scenario, it's a little harder to manipulate tax efficiency if all we have is retirement money, and when we take it out, we got to pay taxes. There are some exceptions to that, but I think a lot of the tax planning things for those types of people are kind of sales tools. There are people that either have inheritance or property or land sales or whatever it is, that if you have after-tax money, then there's quite a lot more you can do with tax efficiency, but it just kind of depends on the boat that you're in. But again, a penny saved is a penny earned, and a penny saved in taxes is more than a penny earned, as far as I'm concerned.
We're talking about how to master the retirement income trifecta: cash flow, longevity risk, and tax efficiency with Jake Floyd here of Floyd Financial Group. And Jake, I want to leave our listeners with this thought. Most people spend 30 or 40 years working hard, saving money, and building retirement nest egg. But when retirement arrives, the question changes. It's no longer how much have I saved? It's how do I turn those savings into income that lasts the rest of my life? So if you're within 10 years of retirement, already retired, or simply wondering whether your current plan addresses income, taxes, market risk, and rising healthcare costs, Right now is the time to get that second opinion. Jake here and the team at Floyd Financial Group will sit down with you, review your situation, and help you determine whether you're truly on track for the retirement you've worked so hard to achieve. There is no obligation, there is no cost for this initial consultation, and certainly there is no judgment. So call us today at 417-889-7233. It's 417-889-7233. Leave your name and number. Ashley will return the call, and she'll set you up for that appointment with Jake right here at Floyd Financial Group. You only get one retirement. Make sure you've got a written plan designed not just to grow your money, but to help make it last a lifetime. Jake, time for a break. When we come back here on Show Me the Money, we're going to be talking about how 401k savers just triggered a big market shift. When Show Me the Money continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about how 401k savers just triggered a big market shift.
And Jake, while the media was panicking about the market, retirement savers were quietly doing exactly the opposite. It seems like every time we turn in the news, Jake, we're told investors are nervous about the economy, inflation, interest rates, or the stock market. Yet new data from Fidelity shows retirement savings are doing something very different. What's happening here, Jake?
You know, I want to give a shout out to Mr. Josh Brown out there. He said he's a financial advisor up in the Northeast, and he manages a few $1 billion worth of assets. He's on CNBC and other places, but he's one of the few guys that I really pay a lot of attention to what he's doing and what he's saying. He's a very smart guy. And he did a segment, I don't know, it's probably been a couple of years ago now, but I thought it was very right on. And he said, if you are not retired yet and the market tanks, you should be rejoicing, not being upset, because you're simply buying more shares with every dollar you put in. The day you want it to be the highest is the day that you retire and the day that you take the money out of that 401k. But otherwise, if you're 20, 30, 40, 50 years old, when the market tanks, that should be a very happy day for you. And the last thing you should do is stop funding your 401k. In fact, if you can, you should be shaking the couch cushions out and see if there's any more you can put in there. And that's exactly what the public has been doing over the last year, according to these numbers.
So, Jake, when you talk about the numbers, what numbers stood out to you the most?
Yeah, so the average combined employee and employer 401k contribution rate hit 14.4%.
Wow.
I would never have guessed in my wildest dreams that that number would be that high. So they're saying 14.4% of employee pay annually is going into a 401k. Now, that's likely going to be at least half of that is probably the employer, or the employer gives bonuses and things into a 401k. Mm-hmm. The match obviously is a big part of that, but the employee's probably contributing 6 or 7% on average, or maybe a little bit more, which is a very encouraging number. The people that I see that have the most accidental success is people that just, hey, I just funded my 401k and kind of forgot about it. And that is a strategy that has paid off for millions and millions of Americans, especially people that started working in the 80s, you know, and they were the beneficiaries of some of these big market rallies.
Right.
Fidelity says that the recommended target is 15%, and people are at 14.4. I would imagine that's much higher than it was 5 years ago, 10 years ago, 15, 20 years ago for sure. And so IRA contributions were up 29% from a year ago. So people are feeling better about where things are going. People are bullish on the market. And if 401ks are being funded, it's going to be very difficult for markets to have a bad time, because all that forced buying is a huge part of what makes markets go up.
So, Jake, is this increase in funding the 401ks, do you think that that is because people are realizing that the onus is on them to provide for their own retirement? I mean, Social Security only goes so far. A lot of people don't have pensions. It's all up to me.
I think it's more a market sentiment shift. Right. People are seeing the markets going up. They're realizing that Donald Trump is not going to kill them financially. I think it's a reflection of people's positivity on not only the world, but the market. And so, again, that's a very encouraging sign to see those numbers up. 1 in 5 workers increase their savings rates. I mean, again, these statistics are pretty amazing. I do think that as we look forward, we don't want people to get too bullish, because that's what the top looks like, right? We don't want them to be going too crazy, but The fact that people have not lost faith in the market and have not lost faith in the American way. I think about over the last week or two how we've seen a lot of these foreign people coming into our country for the FIFA World Cup.
Mm-hmm.
And if you're watching the news on CNN or Fox News, you're never going to see this. But if you're watching it other places like X or wherever people can just post freeform video, there's lots of video out there of foreigners coming in and going, hey, we've seen these movies and we just thought it was all fake. But America really is what it looks like on the movies and on TV. And there was one guy and he was like, if I was an American, this guy was British, and he said, as a British man, I can take a 40-minute flight to another country. He's like, but Britain doesn't have everything that I would want to go see. He said, if you're an American, what do you even need a passport for?
Right.
You know, you've got the mountains, you've got the desert, you got some of the best beaches in the world, you've got the Midwest, you've got everything you need. Why would you ever need to go to another country? He said, so let's stop calling Americans uncultured because they haven't been anywhere else. They don't need to go anywhere else. And I think that sentiment is a reflection of the world's view of us, but also how Americans' perception of themselves is starting to shift back to what it used to be, which was pride in the American way and the country, and just an overall sense of unity that I think we have lost since 2020 in a lot of ways. But I think we're starting to see the kindling and the spreading of that fire again. And I think the rest of the world sees it. I think we see it. That's a good thing. And I think these numbers reflect that, because
Right.
if you're investing in your 401k in America, you're investing in America. I mean, you are investing around the globe too, but mostly you're investing in American capitalism, for lack of a better word.
Right, and we see the people in those videos chanting USA, USA. And when you've got the foreigners chanting USA, USA, it really is quite powerful there too. Jake, Fidelity also found that investors weren't making major changes to their portfolios. Is that a good thing?
For the most part, yes. A lot of people think that they can trade their way around bad markets and then trade back in when things are good. In fact, if I had a dime for everybody that came in and asked me, like, well, why don't you sell when things are bad and then just buy when they're good again? I'd say that's exactly how you make 2% a year instead of 10. Because if you're buying when everything looks good, you're at the top, and you're buying right before it's going to go down, and vice versa. So I think, yes, it's a good thing, because that means they've been making money, which means they're satisfied with their returns to some extent. But it also means that they're not trading their way around into a poor position because they're so focused on moving money in and out. Most of the time, you just lose money doing that. There's a few people that are successful trying to time the market, but there's an old saying on Wall Street that says, time in the market is better than timing the market.
Talking with Jake Floyd, Floyd Financial Group, and we were talking about how 401k savers just triggered a big market shift. And again, if our conversation piques your interest, you'd like to get in and sit down with Jake here at Floyd Financial Group, talk about your journey towards confident retirement, and including a conversation about 401ks, if you would like, call 417-889-7233. It's 417-889-7233, and schedule that consultation with Jake. It's just a casual conversation, and it's not going to cost you a dime. No cost, no judgment, no obligation. We'll meet you where you are. 417-889-7233. Jake, this study from Fidelity also mentioned that another thing that was happening was an explosion in Roth activity. Talk about that a little bit.
I see a lot of people funding Roth accounts that maybe shouldn't be, simply because they're paying taxes today at 27% or maybe even as high as 37%, hoping to save that tax money later. If you're going to be in a higher tax bracket when you retire than you are now, then the Roth can make sense. If you are not going to spend your money at all and you want to pass it to your beneficiaries after tax, that can make sense. If your kids who are going to inherit that money are in a much higher tax bracket to you, that can make sense. But I would say there's a lot of Roth pushing where there really shouldn't be. There's a lot of people using that as a hook, other financial advisors trying to get people in the door saying, hey, you really need to fund a Roth, when in reality, it's just a way for them to get them in the door. There's nothing inherently wrong with Roth conversion or Roth activity, but I would say that if you're in your primary earning years as a married couple, there's a fairly good chance that saving that money and saving more, meaning doing a traditional IRA or 401k and saving that tax money today and using that so that you can fund more each year, mathematically can be a better strategy. It depends a little bit on your situation, but I think saving in general is a good thing. I think more people know about Roth today is part of the reason why it's taking off, and employers are pushing the fact that they have a Roth 401k option more than they ever have in the past. So I think that's a reflection of that. Roth is a little bit misunderstood, especially by looking at this. Roth accounted for 67% of all IRA contributions. That is a huge number. Again, nothing wrong with Roth, but you need to make sure you understand the implications of funding a Roth versus a traditional. And depending on how old you are, depending on your insurance setup, when you want to retire, there's a lot of factors to consider when you're looking at Roth versus traditional. But I think the fact that the overall number is going up, I'm definitely happy with.
So a Roth conversion is not right for everyone. I mean, done properly, they can save substantial taxes over a lifetime, but done incorrectly, they can also create unnecessary tax bills. Jake, the report also credits automatic enrollment and automatic increases. Why are those features so powerful for people in a 401k?
Yeah, I think that it's human nature to procrastinate. And so to have these things automated to where you don't have to think about them is a good thing. And it helps you be disciplined without actually having to be disciplined. And I think as far as humanity is concerned, that's a good thing because most humans are not terribly disciplined. And so if you just put that automated, you don't learn to live on that money and you just save it. Increasing your contribution automatically by a percent each year is a great idea. You're probably getting 2, 3, 4, 5% or more per year increase in your pay. So if you just have that automatically happen, then you don't learn to live on that money and it just goes into your 401k, which again is a great idea. Over 20 or 30 years, the impact of increasing that 1% per year could be double your account value or more even, depending on your situation. So those small tweaks really make a big difference in the end.
Talking about how 401k savers just triggered a big market shift with Jake Floyd of Floyd Financial Group. Jake, what is your takeaway on our conversation here this morning?
Yeah, I think that successful investors are not trying to predict the market. They're just simply being disciplined and they're using habitual investing to their advantage. And consistency is the key in many things in life, and it goes triple for investing. If you just keep on keeping on, in the long end, you're going to win. And so I think people are becoming more tax aware. They're looking at Roth versus traditional, which again, I'm not sure that everybody funding a Roth should be, but at the same time, just the fact that they show any interest in that is a step in the right direction. And overall, paying a little more attention to this stuff and treating it as a priority is a recipe for long-term success.
Good conversation, Jake. Let me talk to our listeners here for just a moment. If you woke up tomorrow and discovered that your 401k wasn't positioned to provide the income that you thought it would you want to know now or maybe 10 years from now? The investors that we talked about today aren't succeeding because they're smarter than everybody else. They're succeeding because they had a good plan and they're taking action. If you would like to talk to Jake Floyd here at Floyd Financial Group about 401 contributions, if you've got one, you're still working, maybe you want to convert your 401k to an IRA, we can talk about it all here at Floyd Financial Group. And again, it's not going to cost you a dime. Absolutely no cost, no judgment, and we'll meet you where you are. Certainly no obligation. Call 417-889-7233 to schedule that conversation. Again, it's just a casual conversation with Jake here at Floyd Financial Group to put you on a path towards a confident retirement and answer any and all questions that you might have. Again, it's not going to cost you a dime. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, let's take a break here on Show Me the Money. When we come back, we're going to be talking about which is better for your IRA, mutual funds, or an exchange-traded fund or an ETF. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about which is better for your IRA, mutual funds or an ETF.
And Jake, today we're talking about ETFs versus mutual funds, exchange-traded funds, if you will, inside an IRA. So let's start with the basics. What are they and why should retirees or pre-retirees care about them?
Sure. So both ETFs and mutual funds allow investors to own a diversified basket of investments. I mean, diversified is you being a loose word. Some of these are like a semiconductor ETF is all the chip companies out there. Sometimes these are based on indexes. Sometimes these are based on some guy who's managing the money. but both are a collection of stocks, bonds, and maybe some alternative investments. The mutual fund originally was kind of designed to dumb down investing so that you could just buy a package of investments, or you could allow a manager to manage those investments for you. And that's why they really took off. An ETF came along later and is a little bit more modern version of a mutual fund, but there's some key differences that we'll talk about. But overall, you can be diversified inside of both. That's an important thing to have because we don't want to put all our stock in one stock, so to speak, right? So what's the best way to own those investments? And one of the issues that we come up with sometimes, or a lot of the time, is what do you actually own inside that mutual fund or ETF? And I think most people don't really know. If I have the Vanguard Small Cap Value Index Fund, what is in that? What companies are in that? And most people don't know.
So, Jake, to your point about the differences here, many people have heard these terms, but they don't understand the differences between an ETF and a mutual fund. So what is the simplest explanation that you can give to us here?
Yeah, I think that mutual funds are kind of one of the original diversification tools out there. And the idea was, instead of buying this stock or this stock, let's buy the mutual fund, which has quite a few different stocks in it, and or bonds for that matter. And that will diversify us away from single stock risk. The thing I would push back on there, though, is that mutual funds have also been the number one instrument to pull the wool over the eyes of individual investors. They're used by big institutions to make more opaque the investing world, meaning you can't see through it. It's not transparent. You don't know what you own. You don't really understand the fees that you're paying. You understand the expense ratio, maybe, if you're a more sophisticated investor, but there's more cost than just that. There's turnover costs. There's lots of cost inside the funds that you don't see. A mutual fund will also retain the right to trigger capital gains, causing you taxation just because it feels like it at the time. There's a lot of things going on that you don't realize are going on.
So, Jake, let's talk about costs, because those can quietly eat away at retirement savings.
Absolutely. Fees matter, and it's probably the number one common denominator between success and investing failure is how much are you paying in fees. And I think there's a lot of advisors out there that are not doing the greatest job of exposing that or showing people what they're actually paying. And why are they not saying that? Because they're the ones gouging the client. They don't want you to know what they're paying because they want you to keep your money there and they want to keep making the money off of you. I have designed my practice to try to pay as little in fees as possible, and I'm considerably lower in fees than the average advisor in this area. I don't know if I'm the lowest, but I'm definitely very close if I'm not, just because I don't know every single advisor out there. And I do that on purpose because I am 41 years old, and so if I charge you less today, guess what? You have more money later, right? You have more money. And if you have more money and I charge a fee-based fee on your account, then that means my fee goes up as you make more money. And so if I charge you less now, then both of us win later. And I like that strategy better. I like to be on the same side of the table as my client. I like to win when they win. Fees are a big deal. If you pay 1% less in fees, over the next 30 years, you're going to have twice as much money. And that's a big deal. And there's a lot of people paying 2 and 3% annually in fees, and it's just killing their returns, and they don't really even understand it's happening.
Well, that's what I like about Floyd Financial Group, is that you realize that lower costs means more of our clients' money stays in our clients' pockets and working for them. Why are ETF expenses usually lower than mutual funds?
There's a couple of reasons. ETFs are generally more transparent than mutual funds, so there's less that they can hide inside there. That's one reason. Another reason is most ETFs are also passively managed, meaning they have a mission statement like to track the S&P 500. And because that process is more automated and doesn't require research and therefore a skyscraper on Wall Street to manage it, then the cost is less. They're employing less people. You have fewer people getting paid out of your money. That's one of the things I tell people is we want to minimize the amount of people getting paid before you get paid when it comes to an investment, which is why I'm generally not a big fan of REITs and other complicated investments, is because you have so many layers of people getting paid before you get paid that you're lucky if there's anything left. And so when we're looking at investments, the less people getting paid, the more money you make. But generally with ETFs, the big saver is that it's passive versus an actively managed fund. We think about like the Magellan Fund that might ring a bell for a lot of people that are 50 or 60 listening to this show right now. There was a really successful fund called the Magellan Fund, and it was making all these returns. It was an actively managed fund, and the fees on it were just atrocious, but they were still making a lot of money, mostly because it was the 80s, not because they really had a lot of personal success. But I do think that when we're looking at ETFs versus mutual funds, there's two main differences. One is, generally speaking, active versus passive management, although there are passive mutual funds and active ETFs. I'm just saying categorically. But the other thing is how they trade. And this is one of the nuance that most of the time is not a big deal, but occasionally it is a really big deal, is that a mutual fund trades no matter when you push the sell button at the end of trading that day. So if at 9 a.m. you say, hey, I want to sell this mutual fund, you're going to get the price at 3 p.m. Central Time. With an ETF, it trades like a stock, so it trades on the open market, and so it's going to trade live. If you push sell at market at 9 a.m., you're going to get the price at 9 a.m. Now, again, many days that will not matter that much, but I think it was March 23rd, I believe it was, on 2020, the market opened 2% down and finished 13% down. So if you push sell thinking you saved yourself some money at 9 a.m., and then you went back to it at 3 p.m., you had actually lost 11% more than you thought you had. Sometimes it matters. It doesn't matter most of the time, but that's another important distinction between mutual funds and ETFs.
So trading flexibility, that's what you're talking about here. Why is that so important for retirement accounts? I mean, most people aren't day trading their IRA, are they?
So that is becoming more and more of a thing, actually. Not so much IRA, but their actual retirement accounts. 401ks, 457s, 403bs. There are these little groups that get together and they compare their returns, and they're basically gambling with their retirement accounts, and some are winning and a lot of them are losing. That is kind of becoming a very interesting dynamic that really wasn't the case before. But I would still say the average 80 to 90% of people are not doing that. And inside of your 401k, most likely the only options you have are mutual funds, not ETFs. Now, there are some firms that are pushing back on that and allow you to buy individual stocks, basically self-directing your investments. So it takes the money out of your 401k and puts it in a self-directed account so that you can trade pretty much whatever you want. Fidelity does that. Some others do it. But you're also kind of it's a little bit like handing a loaded rifle to a 5-year-old because you have no idea what you're doing, or the vast majority of people don't. But you're giving all this control to them and really giving them maybe more rope than they deserve, especially when they have nowhere to go to get help if they need it. I am for freedom in all of its forms. So I think in America, I ought to be able to lose my money buying an investment if I want to. At the same time, I do think there needs to be some kind of a disclosure that says, hey, you realize if you do this, you can lose all your retirement money and not be able to retire. And as long as they're okay with that, then I think they should be able to. But I think there's a lot of people that don't understand the risk they're taking by trading their account frivolously, or doing the self-directed trading, or just buying the most aggressive thing they can find inside their 401k when they're 2 years from retirement, those types of things.
Talking with Jake Floyd, Floyd Financial Group. We're talking about ETFs versus mutual funds. Again, our number, 417-889-7233. If you'd like to sit down with Jake and talk about those two things in your retirement portfolio. No cost, no obligation, certainly no judgment. 417-889-7233. So ETFs and mutual funds both have their pros and cons. Is it a good idea to own both of those in your IRA?
Potentially. It depends on how specific you want your trading strategy to be. I've met lots of very successful 401k savers that basically had a S&P 500 index mutual fund and just rode it all the way through and ended up with a whole bunch of money. That doesn't make that strategy right for everybody, but it is a viable strategy. However, having a mix is generally an okay thing. Inside a retirement account, though, you may not have the ability to have a mix because you may not be able to have ETFs. If you have that money rolled out into an IRA, though, and that's the primary reason why you want to roll out to an IRA when you can, is having investment freedom. Instead of being limited to 30 mutual funds, you can have access to all 160,000 mutual funds, plus stocks, bonds, ETFs, whatever you want. But it's important to have somebody who knows what they're doing help you out a little bit. It's like, let's say that you decided you wanted to make a samurai sword, and you've never made a samurai sword before. You have no idea what you're doing. Could you make a sword? Maybe. You might be able to, but wouldn't it sure be nice if you had a master swordsmith there to guide you through the process and tell you what to do each time and make sure you don't hurt yourself or kill yourself or whatever? That's how I would look at it, is if you really don't know what you're doing, you're dealing with a weapon of mass destruction, right? As you're trading your retirement accounts, there's consequences to those actions, and you want to make sure you understand what they are so that you don't get hurt in the process.
Jake, let's talk about Roth IRAs for just a moment. Does that change the conversation at all?
It does. It does a little bit. Both IRAs and Roth IRAs are going to have the same tax treatment, meaning as you're trading, you're not generating taxable events, versus if you have an after-tax account, when you're trading, you're potentially generating tax consequences for yourself, both positive and negative. There are some people that think that we should have our highest growth assets in a Roth, but that's assuming that you know what your highest growth asset is, which I think in my experience is a pretty big assumption with the average IRA or Roth IRA holder. I don't know that everybody understands what that is. And because something has been really high growth the last 10 years doesn't mean it's going to continue to be really high growth. So ideally, though, if you can keep most of your growth in a Roth, then that means that growth will be tax-free after 5 years and should help you in retirement. I would suggest, though, that that's a little bit overly simplistic, and there's a little more to the picture than that for the average guy trying to do it himself.
Jake, let's bring this full circle here. What is your final takeaway for our listeners today?
Yeah, I would say that neither mutual funds nor ETFs are bad. On average, I like ETFs better than mutual funds because they're lower cost, again, on average, not categorically. And you can also see what's going on behind the scenes. ETFs tend to be a little less arbitrary than mutual funds, so you don't have some superstar money manager and you're just putting all your faith in him to carry you through. So we need to pay attention to fees. We need to pay attention to diversification. We need to understand what we own. Those are probably the biggest things I would take away from this discussion. Talking with Jake Floyd, Floyd Financial Group, we're talking about ETFs versus mutual funds. Again, if you would like to sit down with Jake and have that conversation about these two investment tools in your portfolio, maybe you've got some questions, well, Jake's got the answers for you. Request your Floyd Financial Group retirement review by calling 417-889-7233. Of course, the conversation is not limited to just these two things. You can talk about anything that's on your mind, and we would love to help you out. 417-889-7233 is the number to call to get your conversation started. No cost, no obligation, no judgment. Again, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, it is time for our final break. When we come back, we'll be talking about what happens if you die without a will in Missouri, when our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to be talking about what happens if you die without a will in Missouri.
All right, Jake, so let's start with that simple question. What actually does happen if someone dies in Missouri without a will?
Jeff, I think that a lot of people assume that their investments will just automatically go to who they want, whether that's their spouse or their kids or whatever. That's really not the case in most cases. If you die without a will in the state of Missouri, the state of Missouri, through the probate system, will kind of create one for you. The probate court follows intestate succession laws. So somebody from the court's appointed to handle your estate, and the state will determine who receives your assets according to basically your heirs at law. So it'll go out and find immediate family first, and then more distant family and more distant family. And what you wanted really doesn't matter because they have no documentation based of that.
So your personal wishes many times don't matter, Jake, because they were never documented. I mean, that's a little shocking. So who does get the money in this case?
Yeah, so it depends on your family situation. If you're married with no children, your spouse would generally get things. But if you're married and have children together, your spouse is the primary beneficiary and then followed by your kids. But if you have anything else going on that's more difficult than that, first of all, that process will take a while to sort itself out, 7 to 10 months in a lot of cases. So it's not like it's a quick thing that can happen. If you have a trust, then it is a relatively quick thing in the state of Missouri, and we can bypass the probate system on most assets completely, which saves you money, time, and most of all, headache. If you're listening to this show and you've ever had a parent pass away on you, you'll know what a headache it can be, whether they were prepared or whether they weren't prepared. It's a headache either way. It's just a way bigger headache if they have no documentation. There's other considerations too, is whether you actually want your kid to directly inherit, right? Let's say you have a kid that has a drug problem and they get a hold of $50,000 once you're gone. That could be a problem. Or if you have a kid that's disabled and they inherit money and it kicks them off their disability, kicks them off their benefits, and they have medications they can't pay for now. I mean, there's a lot to consider.
So, Jake, if you die without a will, the state of Missouri decides who gets your stuff. But if you do have a will, isn't that just an appointment with a court for something called probate? What exactly is probate and how long does it take here in Missouri?
Yeah, if Dad was sitting here, he would say where there's a will, there's probate.
That's
And
right.
where there's no will, there's still probate. And the trust and direct beneficiary designations can get around probate. But if all you have is the will, it's a little bit of an oversimplification, but it's basically instructions to the probate court. They're going to say, hey, here's what they wanted. And then the court's going to take over and say, okay, well, we'll determine if that's really what they meant. And we'll see if there's any creditors first and see if anybody wants to object and try to get a hold of some money. And heaven knows that everybody wants to get a hold of money.
Right.
You're opening yourself up for a lot of things that you don't have to open yourself up for.
So the order of getting paid, creditors get paid, taxes get paid, then whatever else remains is distributed to heirs, but that is the order there. Creditors and taxes first, and then whatever is left. So how long can probate take here in the state of Missouri?
Yeah, so each situation is different. If you have a small probate, sometimes those are settled in a month or two. Bigger estates can take years. I mean, literal years. I would say on average, and again, this is an educated guess, this is not the state reported number, I would guess it's somewhere between 7 and 10 months on average, if I had to guess. And if there's a lot of disputes and a lot of court proceedings and a lot of finger pointing, I've seen probates go 5 years plus. Just kind of depends on how much fighting is going on and how many people have an axe to grind in the situation. But on average, I'd guess 7 to 10 months.
So, Jake, what about retirement accounts with life insurance policies, that sort of thing? Do those go through probate as well?
Yeah, so things that have direct beneficiary designations typically are going to go around the probate system and go to who you want. So your 401k typically is, if you're married, goes to your spouse and you have them as a beneficiary. If you have no spouse, then whoever you list directly as a beneficiary on your 401k IRA, they're going to get that. So brokerage accounts, if they have TODs, bank accounts, if they have PODs, vehicles, if they have TODs, those things will kind of go around the probate system. A beneficiary deed is also a good thing to look into, which is basically like adding a beneficiary designation to your house. Those are called different things in different states, but in Missouri, we generally call them a Benny deed or a beneficiary deed. It's important to check these things from time to time, too, because if you get a divorce, you may have an old spouse that's still on the beneficiary deed. There's all kinds of things that can happen. And so a lot of times, if you have some means, having a trust can make a lot of sense because you can spell out exactly how you want things to go. And then you have one place to go to make those changes if you want to. If you want to make changes to your trust, you change the trust. And then we list, let's say, accounts either in the name of the trust or with the trust as beneficiary. Again, I'm hitting this very high level. There's situations where you don't want to do that. Like IRAs, we don't want to make the owner the trust because that triggers the taxes. So again, please don't listen to what I'm saying here and go, hey, he said to do this, because that's not what I'm saying. We have things that we need to be careful of that happen. But in general, a trust can save you a lot of time and frustration if you have a property and some means to do that. Trusts are not egregiously expensive, but they're not the cheapest thing in the world either. It's going to be more money than a will, But generally speaking, again, if you have some assets, it's going to be cheaper than the probate proceeding would be.
So when you talk about TOD, that is transfer on death, and then POD is pay on death. I know with a POD, you can get that at the bank. You have to have the person that you want the account to pay to there so they can sign off on it. But how do you do a transfer on death?
Yeah, so if we're talking about a vehicle, you go down to the DMV and have them add a TOD. It kind of depends on what we're talking about. If you have a brokerage account, like a non-qualified or an after-tax brokerage account, you can add a form on most brokerage accounts called a TOD form, which is basically just adding a beneficiary to an after-tax account. Generally speaking, it's as simple as just asking for a form on a lot of this stuff. But if you don't do it, and a lot of people don't do it, it can really cause a lot of heartache later.
So, Jake, let's talk about long-term care. How does that impact an estate?
So when it comes to long-term care, having a will or having a trust, a revocable trust, is not going to change a ton of things for long-term care. However, there are types of trusts that are irrevocable. I know that's a scary word, but an irrevocable trust can help protect from creditors and liabilities, including long-term care. But there are limitations to that. You really need to talk to an elder law or estate planning attorney about the differences between different types of trusts, what kind of creditors they can help protect you from. And again, these are future creditors, not current creditors. You cannot stuff your money in a trust to protect it against creditors that already exist. So don't think I'm saying that. But having a conversation with an estate planning attorney can help clarify some of these questions for you. Again, there's a lot to consider here, so I don't want to oversimplify it. As people who know me know, my wife, Elizabeth, is an estate planning attorney. There's a lot of other estate planning attorneys in the area. Seems like there's a new one every day. So you can get those questions answered. Elizabeth would be happy to sit with you. She doesn't charge to sit down. But again, you certainly can go to any of those other attorneys and try to get some advice there. But there's a lot to consider, whether we're going with a will, a trust, revocable trust, irrevocable trust. One of the things we didn't mention is probably one of the best things you can do that isn't really that arbitrary is having a good financial power of attorney, so that if you're unable to act for yourself, somebody can act on your behalf. That's a big one. Some of those are springing, some of those are durable, meaning you give that power now. But these are some things that you can ask the attorney about when you sit down to talk to them.
We're talking about dying without a will in the state of Missouri. And Jake, you can have a will inside a trust. That is probably what I think a lot of people want to have here. If someone does not have a will, Jake, where do we start with all this?
Yeah, so you can talk to a financial advisor and talk about your assets and things like that and see if a trust could potentially make sense for you, and you could get a recommendation from a financial advisor. Or you could sit with an estate planning attorney, elder law attorney, and see their thoughts on the matter first. I will say that neither one is probably sufficient on their own, because a financial advisor obviously cannot write a trust. That's a legal document. But some estate planning attorneys, elder law attorneys, tend to discount things like taxes, and they're not as focused on investment performance and things like that. So having a team of those people is generally a good idea, just to make sure that we're not missing anything. So we're taking note of investments, taxes, and estate planning. Those three things together are a very important part of any successful retirement.
Well, here's the reality, I think. If you don't have an estate plan, Missouri already has one for you. The problem is that it may not be the plan that you would have chosen. Estate planning isn't just for rich people. It's for anyone who loves their family enough to make life easier for them when they're gone. So if you have questions about a will, a trust, or estate planning in general, call us here at Floyd Financial Group, and we'll sit down and hash it out with you. 417-889-7233 is the number. No cost, no obligation. It's just a casual conversation. 417-889-7233. And again, you can always find out more about us online at floydfinancialgroup.com. Well, Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners here in the last bastion of sanity for joining us. So for Jake Floyd, I'm Jeff Shade, wishing you a great weekend. Be sure to join us again next week right here for Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.